In one of my videos which compare pension withdrawal schemes, one of my viewers asked how would a strategy of gradually moving investments from a pension into an ISA using the different withdrawal methods compare. In case you haven't watched it and would like to catch up, here's the link. However, when I got thinking about this, I wondered whether it even made sense to move money from the pension pot into an ISA. At first glance, it seemed like a sensible strategy since pension withdrawals are taxable, whereas ISA withdrawals are not. But the more I looked into this, the more I realized that we should be careful here. Why? Well, first, let's quickly go over why defined contribution pensions offer other unique advantages which still makes it an attractive investment wrapper. First, pensions are a tax-deferred wrapper, meaning the money that goes in at first is tax-free, but when you do withdraw it, then it is taxed as income. However, you do get 25% of withdrawals tax-free, up to a limit of course. They also offer legal protections as it is shielded from bankruptcy and legal claims. Pensions used to sit outside your estates for inheritance tax purposes, meaning that it was not subject to inheritance tax. However, changes to the legislation brought in by Rachel Reeves means that from April 2027, this will no longer be the case. Now, this is a huge and pretty controversial change, but it seems this will actually come into effect. At least so far, it seems that way. In case you die before the age of 75, the pension pot is passed to your heirs and withdrawals from this pension pot is tax-free. But remember, IHT might still be due because of the legislation changes I mentioned. The inheritance tax rate can be up to 40%, so pensions are not as attractive as they used to be. The downside, on the other hand, to pension pots is that they are not accessible before retirement age, but for some that might be a good thing. ISAs, on the other hand, are tax-free wrappers. The money going in has usually already been taxed, but there's no further taxation on capital gains or dividends. So why might it make sense to move money from your pension pot into your ISA? Well, once in the ISA, you don't have to worry about income tax. But remember, withdrawals from your pension pots are taxable. Nevertheless, you can still benefit from the 25% tax-free cash and pay lower taxes. This is especially useful if your withdrawals keep you in the basic rate tax bracket, as well as utilization of your personal allowance. This means, in theory, assuming you have no other sources of taxable income, you could withdraw £16,760 tax-free and add it to your ISA. Why 16,760? Well, here's the simple math. If you want to completely offset your taxable income against your personal allowance, then you would want the taxable part of your withdrawal to be equal to your personal allowance, which in this case is 12,570. Since a quarter of your withdrawals is tax-free and 3/4 is taxable, you divide 12,570 by 3/4, then times 1, which gives you 16,760. Before you think you can move that 16k into an ISA, in reality, however, you would probably need some additional income to cover living expenses, so you're likely to pay some tax. But as long as you remain in the basic tax rate, this doesn't seem too bad, especially if later in your retirement you plan on withdrawing more, such that you'll be in the higher tax bracket. Then later in your retirement, you can withdraw from your tax-free ISA. So basically what you've done is withdrawn in the early years at the basic tax rate, such that later you don't pay any tax from ISA withdrawals. In other words, I see this strategy working particularly if you have very little expenses early in retirement, so you can maximize your tax-free cash as well as your personal allowance to pay very little tax when you withdraw pensions, then move it into your ISA. Further down the line during retirement, especially if you plan on having high withdrawal rates, the tax-free nature of ISA withdrawals means you pay very little to no tax. So this is what I think most people have in mind with this pension to ISA transfer strategy. However, looking closer, I think this can be tricky for two reasons. First, this withdrawal profile is unusual. People tend to spend more in the early years of retirement than in the later years, as they are less able to travel, for example, due to aging. Perhaps towards the very end, we could argue that nursing home costs would increase projected expenditure, or maybe one might start to give more money away to reduce inheritance tax. That's true. But one issue that we've overlooked with this pension to ISA transfer strategy is the tax-free cash growth. See, we often forget that as your pension pot keeps growing, so does your tax-free cash. That's the 25% tax-free I mentioned earlier. The lifetime limit for the tax-free cash is £268,275, which implies that once you reach a pension pot of £1,073,100, you've reached the tax-free cash limit as well. What that means is that if your initial pension pot is substantially lower than the £1,073,100 limit, which probably applies to most of us, you need to be careful with how much you withdraw and shift into your ISA, otherwise you're leaving even more tax-free cash on the table. Realistically speaking, it's more likely that you'll have a small pension pot and spend more upfront in retirement, also known as the go-go years. Therefore, you're also more likely to be better off keeping the money into the pension. When I ran the different scenarios using my simulation tool, it did confirm the points I made above. But obviously, to be safe, you'd need to factor in your situation to get the full picture, example, current and projected income and expenditure, as well as other parameters. This is why I've been working on my tool for years now, since this is quite a complex simulation. But now it's closer to a working model, I can finally start tackling and testing these sort of questions. So what's the key takeaway point from this video? Well, it may sound like a good idea to move money from your taxable pension pot into your tax-exempt ISA, but in reality this works under specific circumstances, and the strategy could potentially put you in a worse off position if you're not careful. One thing you may have noticed is that we've assumed a constant rate of return, when in reality returns can change substantially from year to year. This itself has an impact on the retirement success and therefore worth explaining in the next video. I'll see you then.